Yeah, so this basically shows by year the amount of corporate debt that's maturing. And you can see it really starts to ramp up next year and into 25, 26. And these are big numbers. About 800 billion in 2024, over $1 trillion in 2025. So here we have an interest rate environment, at least presently, far higher than when this debt was issued. And this debt either has to be repaid or refinanced. And if interest rates are anywhere near where they are now, we're looking at we're going to see that chart that we looked at a few weeks ago showing the net interest expense of companies, corporate America not really budging. We're going to see that shoot up. It's almost guaranteed in the math.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart, welcoming you back here at the end of the week. I'm joined this week by my good friends Michael Preston and John Loder, lead partners at New Harbor Financial, one of the financial advisory firms endorsed by Wealthion. We've got a lot to cover in this video here. We've had a lot of actually great videos this week that we're going to discuss their reactions to, but we're also going to talk about what's happening right now in the markets and what might be happening soon in the larger economy. John, Mike, thanks so much for joining me, guys. I want to start by just citing an old parable, the Sword of Damocles. And this is a story about a courtier who was in a royal court. He was basically sort of sucking up to the king and saying, my goodness, you have such a wonderful life, king. You have everything you could ever want here, all the power in the world, all your whims are met at the snap of a finger. Boy, I'd love to have your life. And the king said, all right, you know what? Let's trade places for a day. And he let Damocles take the throne, but to give him a sense of what it's like to be king, where you sort of have threats on all sides, both external threats, other enemies trying to kill you, take over your kingdom, and also internal threats, people looking to stage a coup, potentially betraying you. He had a sword hung above the throne, and that sword was supported by a single horsehair. And it was to symbolize that you have to always be on your guard, because at any moment your situation could change if these external and or internal forces act against you. And after sitting in the throne for a couple hours, Damocles just panicked, said, I can't do it anymore, king, please take your throne back, because he was afraid that horsehair was going to snap and he'd get skewered by that sword. I think that's not a bad parable for some of the threats that are hanging out there. Sometimes we refer to them as black swans. Sometimes we refer to them as by other terms. But there's a lot of potential swords of Damocles that could fall and really injure this market. The day we're talking, the week we're talking, we're seeing the markets cool off here. One of the questions we're going to talk about in just a second, gents, is are we seeing perhaps a reversal here in the market? We'll talk about that, but I'd also like to dive into you. I've talked a lot in this channel about the lag effects, which are essentially events that have been set in motion in the past by the actions of the central planners, particularly the big central banks here in the US. The Federal Reserve is the big one. We've raised interest rates faster and by a greater magnitude than we ever have before in history. That is highly likely going to have big repercussions. They haven't arrived in full force yet. We'll talk about why, this concept of stealth liquidity. But there's a lot of potential pain coming, especially as more and more of America has to re-rate to higher debt when the current debt they're holding matures. So lots of swords of Damocles hanging above the overall economy. I want to dive into a number of the important ones with you guys. So why don't we start here? John and Mike, we've had some great interviews this week. Like I mentioned, kicked off the week with Stephanie Pomboy interviewing Jim Rickards about the rumored new Brics currencies and also just the impact of the Brics alliance. We had Gretchen Morgensen talking about the damage that a lot of the big private equity firms are doing to the economy. I also released an explainer video on this topic of stealth liquidity. We'll get into that in just a second. But John, why don't we start with you? What were some of your key takeaways from the Stephanie and Jim discussion. Very curious to hear, Jim packs about 3 interviews worth of material into a single interview. Very curious to hear what resonated most with you. And maybe Mike will then shift to you and get a sense for, because the Brics currency is going to be commodities backed and maybe priced in gold, what impact do you think that's going to have on gold going forward? So let's start with you, John.
Yeah, Mike and I were chatting offline about that interview and just remarked how encyclopedic Jim Rickards is about all these things, kind of geopolitical, monetary linked factors. And man, what a fascinating review of all these things that have, we fail to remember sometimes. Mike and I, and what we do here, we're certainly very aware of the big picture, but we have to also have to manage accounts for clients on a shorter term basis without these big, multi-decade type of trends, swaying every decision we make. But yeah, they talked about this pathway to where we've gotten, really playing out over the last couple of decades. This is not an overnight phenomenon. It's a boiling frog kind of slow progression. Started out a little bit at fringe, and now they've essentially replicated many of the modern institutions that the developed world has. They've got a comparable entity. I forget the name of it. I can go to my notes, but it's maybe not so relevant, the name. Comparable entity to the World Bank. They've got a comparable entity, and then I'm talking about the Brics countries: Brazil, Russia, India, China, South Africa. Comparable entity to the Intermonetary Fund, IMF. Essentially all these institutions that have been the hegemony of our kind of developed world banking and financial system, they've replicated, and large part of that is because of the essentially marginalization that these Brics countries have received on the part of a very powerful, entrenched status quo. And it's gotten to the point where there's real practical talks about how they're likely to establish a functioning monetary exchange vehicle between these countries. One that, as Mike and you will touch upon, is likely to be backed by commodities, and most specifically gold, and have a lot of features that maybe will exploit some of the bugs in the current fiat system. And geopolitics are definitely front and center with wars being waged, but this is financial warfare. And Jim himself referenced how he's basically been an instructor, I think, at the Naval War College, I think he said, to up and coming military strategists on financial warfare. So these things have become inextricably linked, and very exciting and scary times that we think lie ahead in terms of how this plays out geopolitically, but also in financial markets. So fascinating info. Thank God we have folks like that can help us understand the big picture, because we certainly don't have time during our days to understand the full ins and outs of these big tectonic shifts.
Yeah, and one thing I think that's important to take away from the whole rise of the Brics, if you will, is, putting aside for a moment whether they're going to create a competing currency, and whether the dollar's dominance of the world reserve currency is going to be under more direct attack and all that stuff. It just really does underscore that the world is becoming much more bipolar or multipolar going forward. We've been very used to the sort of unipolar Pax Americana, which has given a lot of great stability to the world, but also given the U.S. a lot of advantages that we've now just kind of begun to take for granted. And Jim started saying, look, when you kind of look at the countries that are coalescing into this Brics alliance, if you look at landmass, if you look at population, if you look at GDP on a price purchase parity basis, if you look at nuclear arsenals, right? I mean, you look at all these sort of power dynamics. It begins to rival the West, and in some cases, population being a good example, it actually has more, right? So it's not just a coalition of sort of the bitter developing world countries that are, angry about the US or whatnot. It is a really substantial force to be reckoned with of companies that are, or countries that are really beginning to enter developed world status. And so one of the outcomes of that, and Zoltan Posnar has written a lot about this, is even if the relationships are relatively friendly still going forward, there's just going to be a lot more demand coming out of this block that is going to be competing for resources that the West has really enjoyed pretty unfettered, first access to for the past 50 plus years. And all of a sudden, those assets, those commodities, are going to become what Zoltan refers to as more encumbered, meaning they're just going to be locked up in trade arrangements that are getting struck between these BRICS countries. And the West is going to have to either pay more for them or not get as many of them as it's used to getting. And I think that's just going to be a really surprising in a negative way new development for a lot of the West going forward. And that's even sort of under the better case scenario where everybody's still friendly and playing nice with each other. Obviously, if it becomes more antagonistic than that, and we start having things like trade wars or to your point there, John, financial wars, we could really find ourselves, getting matched against an opponent that has a lot more force to push back on us than we've been used to dealing with. We just may not actually have the musculature to really know how to react to that. So anyways, as you mentioned, it's a lot of the discussion with Jim was about a commodity-backed currencies priced in gold that eventually, could really help the rest of the world begin to seriously de-dollarize, at least in terms of its trade and whatnot. So Mike, heading over to you, feel free to add anything onto what John said, but would love to hear your thoughts about what the repercussions of this might be, both for the dollar and the other major Western fiat currency and for gold itself.
Yeah, great, Adam. Thank you. I'd like to add a few comments and just fill in a couple places that I thought were important in the discussion. This meeting is going to happen in Johannesburg, August 22nd to 24th. And what I found interesting is that there's 7 formal applicants at this time and another 14 on the waiting list. And as you said, that's 50% of the world population is comprised of these BRICS countries. And on a purchasing parity basis, 54% of global GDP. So it's quite a bit of purchasing power and quite a bit of commerce. And you're right, the United States has taken for granted the status that we have. Rickards points out that during Bretton Woods, John Maynard Keynes wanted a global currency. He didn't really ever want a monopoly currency that the US dollar ended up having eventually. And this is essentially what he wanted. He wanted to have a global currency backed by commodities that would be fungible around the world and used in trade. We didn't end up with that. Instead, we ended up in the next 70 or 80 years with a stronger and stronger dollar-based world reserve currency. And that's given us unbelievable privilege. We almost don't even understand how much of a privilege that is. If we want 50 or 100 more tanks, we just press a button, print the money, and the world has to accept it. And the whole euro dollar system is just immense. Jeff Snyder talks a lot about that in Eurodollar University, but you need a collateral system or a bond market. If you're going to have a world reserve currency, you have to have a bond market to park the savings. If you get $1 trillion worth of dollars, what are you going to do with it? You can't really sell it back to your home currency very easily. That'll affect the currency exchange rates and end up in pretty severe losses in that trade. So what you have to do is you have to have a deep and liquid bond market. That's what the US dollar has. Well, the BRICS are talking about this, and they're probably going to come up with something, as we talked about, that's gold-backed. And Jim points out that he doesn't think this is the immediate death of the US dollar. One thing that our clients and your viewers need to realize is this is not going to happen overnight. You need a deep and liquid bond market. That's probably going to take time. Jim talked about selling bonds to retail people in these BRICS countries to park their savings. That's probably going to happen, but it's going to take years. And the BRICS countries, I think, want the US dollar to exist, just like Jim said, because it provides a deep outlet to transfer currencies into. And but the upshot of all of this is that likely the US dollar will decline in value over a long period of time, say the next 10 years. So, and you talked about the weaponization of the dollar. That's a big deal. All of these BRIC countries have watched what's happened. Essentially, it's a default, like Jim points out. We have taken away principal and interest payments on treasuries. We've taken away Visa and MasterCard in Russia. We've taken away the SWIFT system. So these countries are creating their own communication networks. You talked about a new cable that's being, or Stephanie talked about a new cable, I think. She called it a submarine cable, I believe. That's providing connectivity and instant payment systems for these countries. I find that really interesting because also the Fed at the same time launched Fed Now last month, maybe to stay ahead of the game and maybe to keep up with everything that's going on. They've created an instant payment system amongst institutions as well. So, you know, the writing is on the wall. We've enjoyed a fantastic privilege for a long, long time. It's probably ending. It's not going to be overnight. It's a process that's probably going to unfold over a number of years. And I don't see how this can't be positive for gold over time. There's no other element, no other commodity that you can go to that is what gold is. I think Jim pointed out there's, I think, 17 different grades of crude oil, a whole bunch of different types of wheat and corn and, you know, different types of commodities. But gold as a element on the periodic table of elements is always gold. So it's probably going to be gold. And I think gold should benefit greatly from this. And gold, as we speak, is hanging in here at about 1950 in the futures market and still has one of the best long-term charts of any asset out there. If you take a look at the monthly chart of gold on a 20-year basis, this giant cup and handle that has formed over the last 12 years or so is very bullish. It still has to break above 2,000 or even 2,100 before it confirms a breakout from that cup and handle. But when it does, it should be a pretty quick trip up to 2,500, and who knows where it goes from then. So we don't know the future, but that's what it looks like right now. I do think that we're going to have a lot of weakness in the dollar going ahead, and probably pretty deep economic crises. We have a hyper overvalued stock market that seems like it has to stay there, or the whole shebang comes apart, so to speak. And it's anyone's guess to how long this can go on.
All right. Well said. One thing I feel just compelled to underscore there to your point is whatever happens with this Brics currency, and again, we're still sort of waiting for it all to be made official, is that it's going to take a long time, like you said. And so, you know, we sometimes get flooded with emails from people when we talk about this topic, where they're panicking and saying, look, I got to get all my money out of dollars today, right? And I just want to underscore, I don't think you guys at New Harbor are saying that in any way, shape, or form. And in fact, and we'll talk about this in a little bit, you know, being long the US dollar or US dollar instruments like US treasuries may actually be really a good place to be, you know, in the near term. Secondly, too, we should just be, you know, cognizant that while I think there's a lot of very understandable reasons why this BRICS alliance is building momentum the way that it is, you know, in many ways, you have a lot of countries that form the heart of it that don't have a great history of cooperation. You know, some of these countries have been at war for centuries, some even longer than that. So we have to also just sort of, I think, have a little bit of a realist view that, like all new ventures, this one's probably going to have a lot of hiccups and permutations along the way in its evolution here, and it's probably not going to emerge as a massive, you know, counterbalance to the U.S. or the Western alliance, you know, overnight. Again, I think the reasons that are driving the coalition, the coalescence of this coalition, are real, and we need to take them very seriously. But again, we should just be measured in how much, you know, kind of probability we give the timing here, right? One quick point, Mike, just on gold. I believe we've talked about this in the past. You know, gold, as you said, is hanging in there, right? It's sort of been soft of late, right? It had gotten back above 2,000. It's now back to about 1950, which is still a relatively, you know, high price for gold. But the mining complex has not performed as strongly as gold has. this year. And so I believe, in your guys' opinion, there are some good values to be found in miners right now, and that they're sort of trading at a bit of a discount to the metal itself. And the reason why I just want to corroborate this with you is I checked my portfolio of miners, which, being really transparent with folks, I've been so busy this year, I really haven't been checking it nearly as often as I should. And I'm seeing that a lot of my miners are kind of lagging in there. But I just want to underscore for folks, and this is one of the reasons why the mining complex is such an interesting one. So I have one stock there that has been a 10-bagger. I bought it last year, I think, for something like 35 cents, and it's trading, at least last time I saw it was trading over $4. So what, that's like 1,000% return. Sure wish I had bought more of it, but still, I'm very happy with that return here. And that's one of the reasons why the mining stock complex can be so interesting, because it is levered to the price of gold. And when you have a miner that really pops, it can pop really big. Now, there's a lot of risk in this space, and I'm not trying to encourage people just to go whole hog into miners right now blindly. But it's interesting to see one of these big wins that I've read about for a lot over the years, and finally have one of them happen in my portfolio. Of course, I'm hoping, Mike, that you're right, that gold begins to really get some wind behind its sails here, makes it above 2,100, and then that hopefully brings the metal quickly to 2,500 or so, and presumably that would really bring the whole mining complex to life. So anyways, I'd love to get your corroboration on what I just said there. Are indeed you still seeing kind of the miners trading at a discount, and is maybe this a good time to be considering maybe doing some dollar cost averaging into the space?
Yeah, the miners are absolutely trading at a discount, a historical discount. We don't have a chart ready for this. I wish we did, but if you look over time, miners trade at a pretty steep discount sometimes, and at a pretty steep premium sometimes relative to the underlying spot metal. Right now, they're at a very steep discount to gold, and have been there for a number of years, literally almost 10 years. So that's bound to revert at some point. What's going to make it revert is the big question. Well, what's going to make it revert is for the public to sit up and take notice that gold is a real thing. I believe it seems like the public is somewhat asleep on this issue at the moment, particularly with all the things that are pending, with this Brics meeting later this month, that type of thing. It is just taking its time in this giant basing pattern, as I talked about before. But the mining complex is very, very profitable at these levels, at 1950 on spot gold. The cost of extracting the metal from the ground is somewhere around $1,200 last time I looked at the data. And you've had Rick Rule on your program before, and his point, I know, has been get access or give yourself exposure to beta in the sector. If we're right on gold, as long as you've got some exposure to the sector, you're going to do well, particularly if that kind of severe undervaluation relative to the spot metal reverses, or even goes to a premium. This is a process that could move these prices much higher. Just to give you an example, I'll use GDX just because it's the most common ETF that people look at. That's trading right around 30 or so, 29 to 30 right now. If gold goes to 2,500 or so, GDX should trade up towards 50 in my estimation. We'll see if that happens, but a lot of money coming into a very small space can move it from undervalued relative to the metal to overvalued pretty quickly, and it could stay overvalued for a long time. To your point, Adam, about how you're investing, you can also buy individual miners. This is another method. It takes a little bit more stomach, a little bit more courage, a little bit more ability to handle risk, but you could buy a bunch of individual miners, cast a bunch of seeds. One of those seeds grows into a big oak tree, and all the rest could go to zero, and it doesn't matter. That's just a different way to approach it. We suggest for most people, just like Rick Rule has said on your program, get exposure to beta. Buy one of the funds or an ETF that invests in that sector, and maybe add in some of the individual miners. There's a lot of good resources out there, newsletter writers, people on your program. But yeah, these companies are very profitable at this level of gold. Nobody seems to be noticing there's some consolidation that's starting to happen in that industry. We start to see some of the big players gobble up the smaller players. That too will boost the prices of these companies. So we really like it.
All right, great. I just want to remind folks, mining space, very volatile. There's a lot of companies that don't go anywhere or go out of business. So there's a lot of risk involved, but you can have some really huge wins too. So I recommend that if you're not a very well experienced investor in this space, if you're going to buy individual stocks, just stick to the really big ones, the Brics, the Newmonts, et cetera, Franco-Nevadas. But if you want to get beyond that, I highly recommend that you follow one of these newsletter writers that Mike mentioned, leverage somebody else's expertise who does follow this space really closely. So follow one of these newsletter writers and or work with a financial advisor that knows how to invest in the space, and they can help you, basically put together a portfolio for you. Okay, so we're going to talk about where the markets are headed in a moment. But before we get there, John, I'm coming to you. I want to get into that sort of Damocles market environment that we have right now that I mentioned in the intro here. I know you've got some charts prepared, a number of which are just basically showing that we are currently at extremes in a lot of places of the economy, where we're just going, extremes are extreme for a reason, right? They're extreme because they don't last for very long. It's an outlying condition. And so a number of these macro extremes are going to have to revert at some point. So I was hoping maybe you could walk through some of those charts and let's talk about some of the key ones you guys have your eyes on. And, on this channel, I've been banging the drum a lot about the lag effect and how it's eventually going to matter. I think a lot of your charts talk about, they visualize what we're going to see when the lag effect actually arrives.
Yeah, Adam, happy. I would like to just add a little bit, a brief add-on to the conversation about the gold miners. As Mike aptly pointed out, we absolutely agree with the notion that the broad space, just getting beta to the broad space through an ETF is a great way. The thing we also encourage folks is to understand that they can be volatile. In fact, we have half of our position for clients hedged with pretty robust put options for downside protection from where we are right now. And in a broad market, stock market sell-off, it's not uncommon for these stocks, despite their undervaluation, to get hit very, very, very nastily to the downside, even if temporarily. So I want to basically paint that proper context. But I'm also going to spill the beans a little bit here. We've gotten asked by many clients to if there was a way we could help them get access to more individual stocks in the space. And one thing to understand about the space is that there's a broad spectrum of companies in terms of their stability and quality and safety, if you will. There's a ton of small gold mining stocks out there that are unproven. They're development companies, very speculative. We think most folks should have no business in those. But we have gotten asked by many clients to, hey, we'd like to get a more curated exposure to the space. So we've been working on developing some strategies, basically to combine some fundamental analysis with some technical tools, but also to provide an income supplement by doing covered call writing against a carefully selected portfolio of stocks. Not quite ready to go live with it, and it's because of the size of the position sizes. It would only be appropriate for folks that had enough to commit to the gold mining space to accommodate the position sizes. And by no means does this render kind of the broad beta strategy that we use for our clients inappropriate or useless. This is kind of a more adjunct to that. But I just want to give a heads up that we're working on that, and we may have some sleeves that we can offer to folks that have a specialized interest in this that are, we think, going to be a bit novel and a bit different than the broad take on the sector.
All right, nice tease there, John.
Yeah,
yeah. No, I'm glad you guys are doing it, and you've been keeping me in the loop on that, folks. I think this is going to be something that a lot of people are going to be really interested when it goes live. But yeah, John, we're going to get a ton of comments here from folks wanting more details that I know you can't share quite yet.
Yep. Well, let's share some of the charts. So yeah, and I'd like to kind of revert back to many of the conversations you've had, Adam, and the one that you had just a couple of weeks ago with Lacey Hunt, Dr. Lacey Hunt. Lacey always comes with very pragmatic data and perspective, and as much as we want to see instant translation of things we see in the data immediately kind of translate to, hey, we're in recession. That's not how things work. There are the very sloppy transmission mechanisms that have lagged effects, and we've talked about it ad nauseum on this channel, but it doesn't change the facts. And Lacey, for example, said oftentimes it's maybe a 7 to 9 quarter lag from when the financial cycle peaks, which we kind of are calling late 21, early 22. So that would put us right into that sweet spot now over the next couple quarters here as to when the lagged effect of some of these things start to take hold. Now, one area of puzzlement, and we've talked about this a few weeks ago, I think we had some charts that showed the net interest expense of corporate America has barely gone up, even though interest rates have gone up. And a big part of that is because corporate America smartly, CFOs doing their job, smartly refinance debt and maybe put too much debt on, in our opinion, at very, very low interest rates over the last bunch of years. That's what they are paid to do, frankly. But the devil's in the details as to when that check comes due. So I'm going to share a chart here that Goldman Sachs put together that basically shows the profile of maturities. Can you see that okay?
Yep, see it just fine.
Yeah, so this basically shows by year the amount of corporate debt that's maturing. And you can see it really starts to ramp up next year and into 25, 26. And these are big numbers. About 800 billion in 2024, over $1 trillion in 2025. So here we have an interest rate environment, at least presently, far higher than when this debt was issued. And this debt either has to be repaid or refinanced. And if interest rates are anywhere near where they are now, we're looking at we're going to see that chart that we looked at a few weeks ago showing the net interest expense of companies, corporate America not really budging. We're going to see that shoot up. It's almost guaranteed in the math. And of course, there are some companies that have cash hoards. They could use some of that cash to pay down debt, but the amount of debt that has been taken out over the last bunch of years has just been eye-popping, and much of it without the kind of typical protections in the debt that debt investors have normally required. Let's look at the household sector here, or the broad, looking at loans from the consumer standpoint. This is a chart I came across, put together, using money data from the New York Fed and Equifax, basically showing delinquencies, percent of balances delinquent by loan type. Now, one thing that jumps out here is the student loan delinquency rate dropped way off a cliff, meaning that there wasn't much in the way of delinquency. Now, that is, of course, a direct result of the college debt forbearance or moratorium that kicks back in, I think, in October, if I'm not mistaken. That's like $1.6 trillion of debt that suddenly starts to come due again. And we're already starting to see corporate bankruptcies notch up. WeWork, for example, just announced that it very likely could be facing bankruptcy. This comes off the heels of companies like Yellow Trucking declaring bankruptcy in recent days. We're starting to see some of those cracks that have been delayed as this impulse of higher rates has slowly but surely worked through the machine of the economy. One other chart we want to show here is one that Mike and I were talking about this morning. We wouldn't do a database discussion justice if we didn't pull in a chart or two by John Hussman, because he puts great stuff out. This is one he put on Twitter just today. And basically what this shows is a couple things. So the maroonish line here, the one that ends right here, that's basically the unit labor cost of corporate America over the GDP deflator. And that's on this axis right here, inverted. And then the other one is basically the profit margins, non-financial, so non-bank corporate profit margins. Now you can see those typically track pretty tightly in a competitive, capitalistic, well-functioning economy. Those things should be competed into line with one another. But what you see here, there are two notable exceptions to this in the last 20 years, right around the lead up to the housing bubble. And then, of course, the last couple of years. Now, what these essentially are, and you can see the words here, basically the undersaving or overspending of the corporate and consumer sector, the government and consumer sector has resulted in a windfall to corporate America that can only be sustained if the deficit spending of government and consumers can be indefinitely maintained. So this was basically consumers taking cash out. Remember those things called cash out refinancings?
Yep.
Leading up to the housing bubble. That's basically, homeowners treating their houses like a piggy bank, taking cash out refinances to spend on any number of things. This, of course, is the government monetary but also fiscal stimulus in the wake of COVID. And basically it's created corporate profit margins that are way out of whack compared to history and way out of whack compared to the underlying labor unit costs. The safe bet, we believe, is that these are going to sharply revert. Jeremy Grantham, I think, was noted for saying one of the most reliably mean reverting series in economics is corporate profit margins. And the last time we saw a departure like this during the housing bubble, it certainly did revert, and we expect the same here, especially now because you have interest rates and inflation being a real confining factor. What's to keep the government from spending like they did the last few years? Well, we've seen a sharp rise in treasury bond rates. We've seen a lot of market reaction that and with the debt loads in the system can't handle much higher interest rates from here. So we're on we think a crash course between the stimulus and the deficit spending that created the surplus and the realities of the consequences of that.
All
so
right.
I'll stop there for now.
Yeah, bring the chart back up if you can,
Sure
John.
thing.
So, it would be interesting to see on this chart, which they didn't put on here, but we'll put it in our imaginations here, is recessions as well, right? And you can see, usually when profit margins diverge too far from that unit labor cost line, and then they start to mean revert, that's generally correlated with recessions as well. What's interesting is we don't see as nearly as big of a we don't really see any divergence during the dot-com bubble, and I guess that's because that was a bubble in stocks that didn't have any profits, right? I mean, that was a big signature issue of the dot-com bubble. But this is when I was talking about swords of Damocles. This is definitely one of them, right? This is just math, right? Both in terms of the mathematical force of mean reversion, but we can play this out in our mind. Okay, well, if profit margins come back down to their historic correlation with the maroon line there, they're going to drop from wherever they are right now, around 14%, down to closer to like sub 10, 9% or so, maybe even 8. For that to happen, companies are going to have to implement a lot of cost controls, right? And that's going to probably result in, obviously lower share prices if they've got lower earnings, right? Because that's just the math of the PE ratio. But also it's going to impact, workers, right? Part of that cost cutting is going to be real layoffs, the type that we see in bad recessions, right? So it's a development that I think we can have pretty high confidence in, unless it truly is different this time. And the only thing that I think can make it truly different this time is if we have some sort of return to aggressive and sustained high-level economic growth. And sure, that could happen. I just don't see any catalyst for it, on the horizon that we can look to say, oh yeah, okay, that's what's going to drive that. So without that kind of visible catalyst, I think we really have to prepare for that particular sort of Damocles to fall. I hate to ask you this, John, but can you put it back up one more time?
Oh, sure. Yeah.
Because I want to go to your first chart there, if you can, back to the debt maturing chart. This, I think, is probably an even bigger sword that's dangling above the economy, right? As interest rates have vaulted tremendously higher over the past year and a half, from basically, at least federal funds rate, basically near zero to now over 5%. And so, yeah, every CFO that could went out and borrowed as much as they could while rates were still low as interest rates started to move. And they're basically subsisting off of the low credit that they still have access to. But as this chart shows, there's trillions of dollars worth of corporate debt over the next couple of years, over $500 billion just this year alone, that is beginning to re-rate. And businesses borrow at a percent above the prime rate. And so if you look at business loans that are being available right now, they're about twice as expensive as where they were at the beginning of 2022, right? So until and unless the Federal Reserve pivots and materially brings interest rates down, as we continue along this time trajectory here, we're going to have these trillions of loans that are going to be re-rating at about twice the percent, at least if things stay where they are right now. They could get worse even. And that is going to create a huge amount of weight that's just going to be pulling economic growth down. And it's going to lead to probably those profit margin compressions that we talked about, and basically be pushing the economy into recession with all of the associated additional knock-on effects that come from that: layoffs, lower financial asset prices, all that type of stuff. So I just want to make sure that folks, this is a great job of visualizing one of those large swords that's hanging over the economy, and literally, unless something changes, that horsehair that's supporting that sword is probably going to break under the sword's weight, and we're going to have to deal with the consequences.
And Adam, we'd be remiss if we didn't point out that all this debt issuance, what did corporations do with that? The funds raised by issuing that debt? We already know, we can look at the data, the actual investment in plant and equipment and productive investment has been anemic. Yet there's been a massive flurry of corporate stock buybacks over the last several years. So they basically issued debt to buy their own stock back in mass, right? Not every company, but we had basically a big leverage buyout by corporate America of themselves. And, that's great on the way up, but on the way down, we may be seeing, kind of offerings that dilute shareholders because companies got to raise money to pay down debt. Because frankly, corporate America has a very poor track record of buying back stock at high levels and selling it at low levels. Buy high, sell low kind of dynamic. So it's a nasty stew. We think this doesn't play out overnight. We're not talking about the sky is falling tomorrow kind of thing, because it takes time to work through. But it's that sword, like you aptly use as an analogy.
Thanks. Very, very well said. And also, even if they don't, I think they will, need to go out and probably raise equity to get their debt paid down, which you're basically raising money to pay down a non-productive asset at that point in time. But also, just putting that aside for a second, we're just removing the pillar of stock buybacks, right? They're too expensive for these companies to do. So one of the things that has been elevating stock prices at artificially elevated levels is now going away simply because they can't borrow cheaply anymore to do that, right? So, just that alone should bring equity values down in the future. Okay, great charts, John. Thanks for preparing those. All right, let's get into the last topic in the remaining few minutes we have here, guys, which is what's going on in the markets right now. We have talked many, many times over many weeks, guys, about the high level of valuations here. You guys have brought up many charts ranging from the Buffett ratio to other charts of John Hussman, showing at current valuations how future returns may likely be negative over the next 10 or 12 years. So we're starting from a point of very rich valuations already. Markets had a big run the second quarter of this year. We're now actually this week, finally beginning to see stocks pull back a bit. Do you guys think that this is sort of the pause that refreshes, the stock market just kind of getting its breath from making such a big sprint, and then things are likely to progress higher from here? Or do you think that this could be the start of something that's more of a real true reversal? Mike, why don't we start with you?
Well, as always, the caveat is we'll see. But I'll tell you, the amount of bullishness that we've seen over the last few months has been pretty breathtaking. FOMO is back, not with everybody, but it's certainly out there. It's out there in the people we talk to. It's out there in the public. It's out there in the headlines that you see in the news articles or the covers of magazines that you see. Both Barron's and another major periodical had bulls on the cover in the last few months. And so here we're sitting at valuations. If you take a look at one of the best measures of valuation, the Shiller PE ratio, it's sitting at 31 right now. The chart that John just showed, these strongly elevated profit margins almost certainly won't last. And so if you adjust the Shiller PE, for example, to what they would look like if profit margins reverted down to 8 or 10, they'd be at like 50 times earnings. It's just not sustainable. It's not sustainable unless central banks can continue to drive liquidity into the market. And it's probably not, it's not going to happen forever. There is no fountain of youth or free money or perpetual energy machine. It just doesn't exist. The question is the timing. What is going to be the spark that causes the whole thing to change? Nobody knows, but we've seen a lot of over bullishness. We're still in what I think is a bounce from the ultimate high. We'll see. I may look pretty silly down the road if I say this, but I still think the high was January 4th, 2022, a year and a half ago. Here we have been on this big bounce. We still haven't taken out the highs, and yet it seems to me that people are even more bullish now than they were back at those highs. If you look at a lot of different measures, it's typical behavior in bear market rallies. So we'll see. We have some of our short-term indicators starting to reverse down, causing us to take some caution, or at least view things with caution. Not all of them, but some of them. And taking a look at the S&P here, we're in a down day at the moment. We'll see where we close, but if we close below 4,400 on a daily basis, and we're right around 4,450, I think right now on the S&P, we're going to leave a string of days above a so-called island reversal. And we've looked at these things a lot over the months and years, and none of them have worked out, right? At least on the bearish side. It seems like every indicator or support zone has worked on the bullish side and none on the bearish side. But that's what happens when everyone kind of falls asleep and really doesn't believe that downside can happen. That's what I think we're living through right now. Nobody believes that the market can go down. Even the most bearish people out there on Wall Street have had a hard time sticking with this. And I saw a chart recently, we don't have it ready, but saying even the most bearish strategist on Wall Street is like net 1% long. So nobody's really short at the moment. So we'll see what happens. We got to close below 4,400. Our main indicators reverse down. We could see a pretty surprising move. Nobody expects that during August. Everyone thinks, well, October is the bad month. We're in the lull of summer. Don't worry. But that's kind of what makes it so unique here. Nobody's worried. At the same time, we've seen VIX, the volatility indicator, go from 12 to 18 or so very quickly. That's a huge jump. It's back.
Yeah, how significant is that?
Here. It doesn't happen that often. I don't have numbers to really, to prove how rare it is, but it's rare. That's nearly a 50% jump in the VIX in, a week or two. So if I had to guess, it probably doesn't happen more than once or twice a year. So a lot of those times aren't relevant. A lot of times in the past, those have been good buying signals. You get a spike in VIX, jump in and buy the market. It's worked. One of these times, though, it's actually the breakout of the VIX. Buying the dip doesn't work anymore, and you get that elevator drop in the market that we've been expecting. So, we'll see. Right now, support zones in the S&P are right around 4,200 to 4,300. And so we get a little bit of a surprise follow through here, maybe even today. Then we could take a pretty quick trip down to 4,200 or so, and then we'll see where we go from there.
Okay.
Adam,
John,
I can pull up a couple of quick charts to add to what Mike just said. So
sure.
let's look at a VIX chart just to put it in context. So this is a chart of VIX, is a monthly chart. So here we are. We're right around 17 right now, 16 and change, I guess. Still very, very depressed here. Obviously the big spikes here are associated with major events. This was the 08-09 sell-off. This was the COVID crash in March of 2020. Right around here is, was in the low to mid 30s during the bottom of October, the October low of last year. So we're certainly not extremely stretched. If history's any guide, there's way more upside ammo here for the VIX to get a little bit more spooked. And this has implications in a lot of different ways, including options pricing. There's been a lot of talk about how cheap it has been recently to buy put options to protect downside. That has been the case. But with that spiking, that basically translates to higher costs to hedge. And that's why, doing things like selling call options to bring in premium to finance hedges is one very good strategy, especially in a heightened volatility market. And that's what we do quite a bit of. I wanted to also just share another chart here to illuminate some of the short-term indicators Mike's referenced that we look at. So this is one here. This is a chart of what's called the bullish percent of the S&P 500. And quite simply, what a bullish percent indicator is, it basically represents the percentage of stocks in that index, again, in this case, the S&P 500, that are on what are called point and figure buy signals, okay? It's a sentiment indicator, not so much a timing indicator, and it's also a contrarian thing. When this gets above 70%, it basically historically has represented a very good signal that it's time to be contrarian. In other words, don't jump on the bandwagon and on the market. It just turns out, however, over the last couple of years, this actually has been quite a good timing indicator. And I don't want to project that this is foolproof going forward, but if you look at any time that both percent got above 70% over the last couple of years here, it signified at least a near-term top. Whether or not we see this fall through again, our take is that this signal going, reverting back down is one to be heeded, and does speak to the likelihood for some air pockets below here yet to come. But we'll take the evidence as it comes, and this is just one of many indicators we'll look at, but just to give folks a bit of a taste for some of the things that we look at.
Yeah, it's a really interesting chart. I know it's only recent that you're basically only going through from 2022 on there, but every time over the past year and a half that we've had that reversal there from the highs, the market's then corrected downwards. So you kind of have to ask yourself, okay, if that correlation holds true, if I don't think that's going to happen, you have to have a pretty good rationale for why it's going to be different this time. All right, interesting, super fascinating. Thanks for bringing that chart up. We're going to have to wrap it up here, guys, in just a few minutes. I'd like to just get your guys' reaction to the explainer video that I put on the channel yesterday that talked about Mike Wilson's commentary there on why the much anticipated recession of 2023 hasn't materialized, right? Very understandable question for folks to be asking. And Mike seems to think that a big reason for why it hasn't happened yet is because it's actually gotten pushed off by what he calls the stealth liquidity that's coming on the fiscal side from the administration with the incredibly extreme deficit that the country's running this year. So just to be super quick about it, we've got the Fed and the banking system still stomping very hard on the brakes from a monetary and a bank lending policy standpoint, right? So their actions are very focused right now on contracting economic growth. But at the same time, you have on the fiscal side, the administration jamming hard on the gas pedal right now with all of the deficit spending that's going on. Yes, we're not approving new fiscal spending packages. We're not sending money directly to households in the way that we did during the COVID pandemic, but we did have the big spending programs like the Inflation Reduction Act that are now actually spending their money directly into the economy now this year. But also the government is just spending at a much higher deficit rate than it has in years past. I think we're running $1 trillion higher this year than we did last year. They just announced the projections for the second half of 2023. I think that's going to be an additional 1.8 trillion that we're going to be spending in these next 6 months. So we are spending, trillions in deficit, trillions more than we normally do. But as a percentage of GDP, we're at an extreme here. And as a matter of fact, we pretty much almost never in history spent a deficit of such a high level percent of GDP while the unemployment rate has been as low as it is right now. As I sort of said in my explainer video, we essentially have a wartime deficit right now with a peacetime economy. And you can't do that for very long without creating some pretty big problems. So what Mike Wilson, who's the strategist of Morgan Stanley, said is, hey, it's this flooding of fiscal money into the system through this rampant deficit spending that is highly likely kind of pushing off the arrival of the recession. It probably otherwise would have arrived coming into the beginning of 2023. It's now been pushed off by several quarters. We don't know exactly how much longer it's going to be pushed off for, because we don't know how long it's going to continue for, but it can't continue forever. And, you know, lots of bad implications that will happen if it does continue for much longer, one of which would be a restoking of inflation, which would completely undo everything the Fed's been trying to do since, you know, March of last year. So curious to get your guys' thoughts on this as a potential explanatory reason for why the recession hasn't happened. And yet, you know, as Mike seems to think, he's like, look, it's not going to be able to continue for much longer. The policymakers are going to have to stop it proactively, or they're going to start getting so much blowback that they're going to have to stop it. And when they do, all those pent-up recessionary forces are likely going to re-express themselves, except this time they're going to be even bigger and even angrier. So, John, let's start with you. I'd love to get your reaction to that.
Yeah, I think absolutely, Adam. And that chart we shared earlier by John Hussman, I think in pictures, shows exactly that short-term kicking the can effect that has maybe delayed what is otherwise probably inevitable. So we totally agree with that. And you know, a quarter here, a quarter that doesn't change the bigger picture of the massively overpriced complex of stocks here in the U.S. That doesn't change. It may just push things out in terms of reckonings and things like that.
Yeah, and sorry to interrupt, but I want you to react to this, which is, yes, I get it. And I agree. It doesn't matter that it's not going to stop the recession. It's just going to delay it from arriving. But what it does do is it sends, I think, a very dangerous false signal to both corporations and to individuals that hey, we're through the storm, right? Yeah. It's over. We're not going to have a hard landing. In fact, we're not going to have a soft landing. We're going to have a no landing. And so people then make financial decisions about their future, assuming that it's all clear. And if indeed the recession has just been delayed, not eradicated, those people get particularly injured because they slam into the recession blindly.
Yeah, and I think we're starting to see some evidence that corporations are probably realizing that the good times ain't going to get better than where they are. In fact, they're probably going to get tighter. Just in the last, just today, I saw I think an announcement, earnings release or something by I think it was ZipRecruiter. They're basically a recruiting firm to fill job vacancies and things like that. And it was pretty ominous. Basically said across the board, they're seeing job postings and budgets for recruiting for jobs, you know, basically being slashed, you know, being basically put on hold. A few weeks ago, I mentioned on this interview with you, Adam, Robert Half, probably the largest temporary staffing company, you know, had pretty dismal earnings growth reports. It speaks to, I think, and I think that the recent JOLTS jobs report spoke to this as well. Maybe we haven't seen the mass layoffs or the firings and this or that or staff reductions, but there certainly seems to be evidence of belt tightening and battening down the hatches in anticipation for perhaps more draconian measures needing to be taken as this kind of fat gets burned off from all this temporary stimulus that is flowing through the system.
Yeah, I actually did a Twitter Spaces last night where I just did kind of a Q&A with folks, and there were several people that gave kind of boots on the ground stories of how they're seeing lots of cost cutting either at their companies or there was one person there whose company kind of they provide a lot of financial advisory and legal advisory services to companies that are finding themselves in financial straits, and they said their business is booming because they have a lot of people a lot of companies that are you know, beginning to enter into that territory. All right, well, look, gentlemen, wonderful as always, folks. For all the reasons that we've been talking about for this past hour, highly recommend, as usual, that most folks watching this video don't try to navigate the road ahead alone, work under the guidance of a good seasoned professional financial advisor who takes into account all the issues we talk about here. Many don't. If you have a good one who's doing that for you, building a personalized portfolio strategy for you, and then executing it for you while keeping you well informed, great, stick with them. Those people are very, very rare. If you don't, though, if you'd like a second opinion from one who does, perhaps even John and Mike and their team there at New Harbor Financial, then consider scheduling a free financial consultation with the advisors that Wealthion endorses. To do that, just fill out the very short form over at Wealthion.com. These consultations totally free, don't cost you anything. There's no commitment to work with these guys. It's just a free public service that they offer to help as many people position as prudently as possible in advance of some of these swords of Damocles that may actually be dropping coming into the future. Mike, I'll let you have the last word here. As you do, folks, if you enjoy these weekly videos with the guys from New Harbor, do us a favor. We'll make sure we continue to keep doing more of these, but to vote your support for that, please hit the like button if you haven't already, and click on the red subscribe button below, as well as that little bell icon right next to it. All right, Mike, you've got the floor to close here.
Yeah, I won't say much. I think that you guys summed up the piece about stealth liquidity very well. All I really want to say is the game won't go on forever. You know, we've been living through this game, so to speak, for the last 15 years. Post 2008 financial crisis, we entered an era of targeting wealth, the wealth effect. It's really a mental thing. And, you know, I know it's real as well in the financial world, but a lot of it is an illusion in a way. It's a game, and it's meant to make us feel secure and safe. But we have all of these other things that we've talked about here today that give us cause for concern, or at least give us cause that this isn't permanent. The million-dollar question is, when does it end? What causes the turn? You know, what's so frustrating for people is that they're either forced to join the game or opt out. You know, and our advice would be to opt out, at least to some extent. And you do that by getting out of index funds that are passively in overvalued markets, raising cash, having some real assets, and just sitting back and having some patience. That's a maddening part of all this. The patience is hard. But, I think we're in a historic moment here, and we'll see what happens the rest of the year. But, things are lining up and have been up for a while, I know. But continue to stay cautious, and thanks for watching. Thank you, Adam, for all you do as well.
All right. Well said to close here. John and Mike, thanks so much. Whatever happens in the next week in the markets, we'll have you guys back here making sense for it for everybody next week. Everyone else, thanks so much for watching.
Thank you.
Bye for now.
If you'd like to schedule a consultation with one of the financial advisors at New Harbor Financial, simply go to Wealthion.com. These consultations are completely free, and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given their latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Wealthion has connected them with so many thoughtful investors just like you over the past decade. We started doing this because so many people have approached us in frustration, looking for a solution because they're feeling out of alignment or downright ridiculed by the standard financial advisors who have been managing their money. You know the type. The kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, "Don't worry, the market will always take care of you." For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing. We strongly believe that today's investors are best served working in partnership with a conscientious professional financial advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you don't, or are having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. Now, for those about to ask, yes, there's a business relationship between Wealthion and New Harbor, which we've put in place to make sure everything is handled according to SEC regulations. All the details on this are clearly provided on the Wealthion.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, If you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to Wealthion.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.